Meantime, in the last days of the year, the stock market tends to perform unusually well during what Wall Street calls the Santa Claus rally. The S&P now has gained an average of 1.3% since 1950. Joining us right now to talk strategy ahead of the last days of 2019, Keith Banks, Vice Chairman and Head of Investment Solutions at Bank of America, Stephen Rees, a Global Investment Strategist at J.P. Morgan Private Bank, and Jim Paulsen, Chief Investment Strategist at the Leuthold Group. Good morning to everybody. Actually, let me ask a statistical question because I don't know the answer. Yes, there's the nice little run-up in the Santa Claus rally, but tell me what happens in the first 10 days of January. Does it get given back or no?
I think markets continue to go higher in the first quarter. I mean, we're talking about the flows just coming back in the last couple of months. We're looking forward to the fourth quarter earnings season. Right. This year, earnings were terrible, right? 1.5% growth in the S&P 500. I think we're going to see an acceleration into next year, helped by a lot of things, most notably trade. So I think it continues to go higher. We could see some consolidation, but those, in my opinion, are opportunities to add.
Right. You're optimistic, too.
We are optimistic. I'm not good at 10-day increments, but as we go into 2020, we're still in the midst of a very aggressive global synchronized easing cycle. Rates are going to continue to come down. Balance sheets of central banks around the world will continue to increase. And finally, we're seeing countries utilize fiscal policy to also drive economic activity. Powerful stuff.
Can I take us back to where we were a year ago? Because Tom brought this up before. He's right. I mean, markets up 37%, and this is for the S&P, from where we were at the low of December 24th last year. How were you guys feeling on Christmas Eve last year? Did you think we would be at this point now?
It was a tough Christmas Eve.
Yeah.
We worked a lot. I think, just keep in mind where we are today with the 30% plus rally, 18 times forward multiple. It's a little expensive, but not, I think, in bubble territory. So for us, this year is going to be all about finding the earnings growth. We think earnings can grow close to 9% for the S&P 500.
So no more multiple expansion. This has to be about earnings growth.
Could possibly happen, but we're not calling for that.
So. You think it'll come in at 9%? Because right now the forward estimates are about 9%, and we've heard from a lot of analysts who say, yeah, but that's going to come down. We're really going to see 5 to 6%.
Consensus starts the year higher. I think the buy-side expectations are a bit lower. I think the risks are to the upside this year with respect to earnings.
Hey, Jim, you there?
Yeah. Yes,
multiple expansion. How much of a possibility is the multiple expansion story in 2020?
Well, I think it's less likely than it's been this year, Andrew, because I think yields and interest rates are going to be moving up in 2020. But we've had periods, even back if you go the last big rally in 17 into 18, where yields went up and P's continued to expand as well. So it could happen, but I don't disagree. I think the catalyst for 2020 gains is probably earnings. One thing I'd point out is we didn't have a bear market in 2018, but we got within a razor edge of 20% decline on December 24th. And so I look back since 1950 at every first-year bull market, and the average of all those is just about what we did here in 2019. In many regards, it felt like the first year of a bull market. A wall of doubt emerges. We had weak earnings, but we were kept going up with massive drops in yields and massive policy stimulus. And we had doubt all year long. I think 2020, a year two of the bull, it goes up another 10%. Typically, that'd be like 3,600 on the S&P if it continues to track that. But the difference is in year two, optimism returns. Fundamentals actually start to improve. Earnings actually start to go up. And even though yields climb, the stock market continues to rise because more and more players that are underinvested come back to the market. Becky mentioned the flow into equities here. That could be a common theme in 2020.
I have a question on the earnings story. One of the characteristics of 2019 was a decline in earnings because profit margins receded because labor costs are rising. What's the math to get to 9% earnings growth? Does that mean profit margins start to reverse higher and labor costs stop going up?
I think it's 4 to 5% revenue growth, a bit of a benefit from stock buybacks, but less than we've seen in the recent past. And then our big calls that margins will actually expand this year.
Driven by
trade.
Can I ask one more question? One of the big issues that's been missing is capital expenditures. CEOs have not felt good about things. If you see the markets pick up, if confidence comes back, could that be the next thing that really fuels a rally? The CEOs deciding, okay, we're going to spend again.
Yeah, that's still a wild card in our mind. Becky, it's a great point, though. We're seeing all this without CapEx really taking off. And another interesting thing to your point earlier, if we were sitting here a year ago, we were expecting 4 rate hikes this year.
Right.
And we got 3 rate cuts.
Right.
And so you talk about a dramatic turnaround.
Just things you can predict and things you can't.
Yeah, and the point around flows is really interesting. We're seeing some flows at the end of the year, and like you said, Andrew, you kind of get that.
Right.
But the flows in equities are still negative this year overall. And if you go back to 2008,
on a really bullish year, so
really bullish year. So back to the PE point, one of the ways you can get some PE expansion, although we are big believers it'll be earnings that drive the rally next year, is if you start seeing real flows, positive flows in equities for the first time since 2008.